Hi, I'm Ira Kalish, Chief Economist at Deloitte, and this is your weekly economic update coming to you this week from the southern coast of Spain. And today is June 22nd, 2026. Last week, the U.S. Federal Reserve announced that it was leaving its benchmark interest rate unchanged, which was expected. But it was still a very important meeting of the Fed because it was the first meeting in which the new chairman of the board, Kevin Warsh, took control. In that meeting, Warsh made some changes. He offered no forward guidance about future monetary policy. He said that he believes that when the Fed offers forward guidance, it distorts market outcomes and makes it difficult for the Fed to get good information from the financial markets. But on the other hand, critics say that this means there's more volatility and more uncertainty and potentially a higher risk spread in bond markets as a result of that uncertainty. In any event, the Fed did continue to publish its so called dot plot, in which the members of the FOMC, both the current and the rotating members, issue their forecast of where they think short term interest rates are going to go over the next year or so. Warsh himself did not offer a forecast as part of the dot plot, but the other members did. And the preponderance of views was that there will be a tightening of monetary policy throughout the remainder of this year. And as a consequence, even though with the new Iran-U.S. deal, which led to a sharp drop in oil prices, expectations of inflation still remain relatively elevated, but more importantly, expectations of monetary policy now are for even tighter policy than prior to the Fed's meeting. In fact, 1 week ago, the futures market indicated that there was a 10% chance that the Fed would raise rates at its next meeting in July. Now there's a 36% chance. Moreover, there is more than a 50% chance that the Fed will raise rates two or more times during the remainder of this year. So evidently, the financial markets believe, in part because of what the dot plots indicated, that the Fed is going to take a tighter monetary policy path over the coming year, despite the fact that we're now seeing lower oil prices and may see even lower oil prices than currently exist if the deal between the U.S. and Iran is successful. That's the update for this week, and I hope you have a good week.